Well, welcome back to State of the Nation. Is Britain on the brink of a financial crisis? Every Labour government this country has ever had has led the country into a financial crisis. You remember, as well as I do, 1931, 1949, 1967, 1976 and 2008. So let's look at what Rachel Reeves is contending with ahead of the autumn budget. The deficit, well, there's an annual deficit of £152 billion for 2024-25, which is over 5% of GDP, and the national debt is about 100% of GDP. Inflation has risen to nearly double the Bank of England's target, reaching 3.8% in July, and the target's 2%. It was 2.2% when Labour took office just 13 months ago, so that's almost double. Borrowing costs. This is really important because this feeds through to the deficit, and it has to be paid every year as the 30-year gilt hits 5.6% this week, which is a 27-year high. And that's before we get on to the £50 billion black hole that has been predicted that the Chancellor Rachel Reeves faces with a shortfall in the public finances. Rumours suggest there's a plan to impose capital gains on home sales or a mansion tax, and this is just a last-ditch effort to try and plug the gap that will have consequences for growth. And there are warning signs. The National Institute for Economic and Social Research predicts sluggish growth, a weak jobs market, rising welfare costs and debt interest payments of over £111 billion. Just contextualise £111 billion, that's more than the defence budget. It's more than the education budget. It is an enormous amount of money. It's akin to what we spend on the state pension every year, just going on interest. So that means there either have to be tax hikes or spending cuts, because to meet her fiscal rules, Rachel Reeves may need an extra £51.1 billion, which would be equivalent to a 5% income tax hike across the board. Then, we've had a cut in interest rates so far, but with inflation rising, that may be harder to continue. So rates came down to 4% on the short end on August the 7th, but economists are now warning there won't be any further cuts this year. This may put pressure on the pound. It's up a little this year, but will it stay at these levels if international markets aren't willing to finance British debt? Conclusion is that with spending out of control, taxes are set to rise further, and investment confidence is dwindling, people are leaving the country, Britain does seem to be on the edge of a financial meltdown. It's another socialist financial crisis. As ever, let me know your views via mailmog@gbnews.com.
If you're a US resident, let's face it, things feel uncertain right now. America's national debt, over $36 trillion and climbing. Inflation, still eating away at your savings. And the dollar, down nearly 8% this year, with more countries walking away from it. Meanwhile, the markets, one day they're up, the next day, trillions gone in a blink. So it's no surprise people are asking, where can I actually put my money and sleep at night? That's why more investors are turning to gold and silver. Gold's up over 24% this year, smashing records and soaring past $3,300 an ounce. And some analysts say we could see $6,000 gold before the end of Trump's term. And silver, it's heating up fast, driven by demand in tech, solar and defence. Some analysts say it could double in value this year. If you've been thinking about moving part of your IRA or 401k into gold or silver, tax and penalty free, our friends at Priority Gold make it simple. They're endorsed by Rich Dad's Robert Kiyosaki, ranked number 1 by Forbes and Financial Services Review, and trusted by thousands of everyday Americans. Right now, GB News viewers can get a free wealth preservation guide from Priority Gold. It shows you exactly how to add real gold and silver to your IRA or 401k tax and penalty free. Step-by-step plain English, no pressure, just smart information you can act on. Just scan the QR code, click the link in the description below, or if you're a US resident, text WEALTH to 24999. That's WEALTH to 24999 and claim your free guide today. The price of gold can go down as well as up. Past performance does not indicate future performance. Only invest what you can afford.
But I'm now joined by somebody who knows the economy better than almost anyone in the country, Julian Jessup. Julian, thank you very much for joining me. Now,
thank you.
Let's start with inflation, because, as you pointed out, the Bank of England expected it would go up, expected it would go to 4%. How worried should we be about today's spike?
Well, I wouldn't worry too much about the increase today because that was partly explained by the big jump in airfares, which I think is just a measurement problem because they're very volatile at this time of year. It's more the trend that worries me. And what I do here, I often compare what's happening in the UK to the euro area. So UK inflation is 3.8%. In the euro area, it's only 2%. So what's explaining that difference? Well, actually, I think a lot of it is down to government policy. So lots of prices that the government now sets, things like domestic energy bills, the national minimum wage, that's all gone up. The other areas as well, so housing costs are rising. That's because we're not building enough houses, and that's partly down to the government too. And then there's the pass-through of the tax increases in last October's budget. So that was presented as a tax on companies, but of course it's become a tax on workers as employer national insurance contributions are reflected in higher prices, lower pay, and fewer jobs. So the main reason why we've got inflation picking up in the UK, much more than in the rest of Europe, is government policies.
And inflation has a consequence on interest rates because obviously people want to get a real return on their money. The bond market really has turned quite sour for the government. The 5.61% yield now on the 30-year gilt is a problem both in terms of the annual budget, because that's a lot of money that can't be spent on public services. But there comes a tipping point, doesn't there, at which the government finds it hard to finance itself. Do you think we're getting close to that, or that's alarmist?
No, I think we are. I think we're in the early stages of a financial crisis already. So, as you say, not only is the economy weak, but there are warning signs in the bond market as well. I think there are sort of three domestic reasons why bond yields have risen, and all of them are pretty bad. One is that international investors don't have a lot of confidence in Rachel Reeves and the government's ability to keep the public finances on track without big increases in tax that could actually just undermine growth even further. So markets are rightly worried, I think, about the so-called doom loop. The second problem is that the Bank of England throughout this period has actually been selling government bonds back onto the market, which is very unusual. Most central banks are not doing that anywhere near as aggressively. So rather than the central bank supporting the bond market, they're actually undermining it. And then the third thing is higher inflation. I personally think the Bank of England will be right to continue to look past the current spike in inflation and keep cutting rates. But the markets are concerned that they won't. So we'll have higher inflation and higher short-term interest rates, which are pressuring the bond market as well.
I'm very interested in those points. I wonder if we could talk a little bit more about the Bank of England selling government bonds, because this seems to me to have a dual negative. One is that it pushes up the yield on government bonds, but also it pushes up the annual deficit because it's making a loss on these bonds, and that has a further effect on the demand for gilts and indeed the supply.
Well, that's right, because when the Bank of England makes a loss by selling bonds at a lower price than it paid for them, then the Treasury has to compensate it for that loss. So that's money that the Treasury has to give to the Bank of England that can't be used for ordinary forms of public spending. The Bank of England itself, I think, has got a rather odd view here. So originally, the Bank of England was buying government bonds to support the economy, to drive down interest rates and to prevent a deeper recession. But it doesn't seem to see the reversal of that policy as doing the opposite, whereas clearly it is. So it's putting upward pressure on yields. It's weakening the economy. It's dampening the money supply. The Bank of England is supposed to be reviewing this policy once a year, and the next review is in September. So it's possible we'll get a change in policy then. But until then, it's not just high interest rates that are the problem. It's the fact that the bank is engaged in this policy of quantitative tightening, which is another form of monetary policy that is slowing the economy.
Indeed, and they've got quantitative tightening coming from the sale of gilts and other bonds with with monetary relaxation by the reduction of interest rates. It's a slightly contradictory policy. I also want to ask you a bit more about the doom loop, because economists depend so much on confidence, and in a globalized market, so much is dependent on the confidence that foreigners have in the UK. There is a point at which the bond market falls, the pound falls, and then people have a great rush to take their money out. This is basically, I suppose, what happened in 1976 when the IMF bailout was needed. Do you think we're close to that?
Yeah, I don't quite think we're in IMF territory just yet. I mean, the big difference back, as you say, in 1976, we had a massive balance of payments crisis. So we actually had to borrow US dollars from the IMF in order to allow the UK to continue buying things that are priced in foreign currency. We're not there yet. So all our borrowing, of course, is in sterling. And if nothing else, the government gets continue to create more sterling to finance those debts if it wants to. So I don't think the crisis will take the form of the need to go to the IMF. But of course, all this, risk of money printing and higher government spending has other consequences. It distorts the economy. It means weaker growth. It means higher inflation. So we get a different sort of doom loop where the economy just continues to struggle. You mentioned, by the way, the forecasts of a black hole of as much as 50 billion. I think those numbers are a bit pessimistic because they assume that growth remains very weak. But that's certainly a possibility. And that, of course, will be the doom loop in action right in front of us. If the government has to keep raising taxes to fill a black hole, then it's just going to undermine growth further. And as you say, undermine business, consumer and investor confidence. And we're never going to get out of that trap.
Well, Julian, thank you very much for that incisive and clear explanation of where we are. I'm very grateful you could join me this evening.